should get 17.5 in year one. And so again, that formula, taking this year's revenues, or H7 on the model tab, times my accounts receivable days assumption, or H22 on the assumptions tab, and dividing that result by 360. All right, so receivable days, receivables year one, 17.5. Fill that across to the right. We see that receivables grow to 21.3 by the end of year 5. Intuitively, this makes sense. As I look at my numbers, I'm always trying to do a little bit of an eyeball or a gut check as I see my numbers. If I see receivables go way up when I know that revenues are only growing 5% and my assumption on receivable days is staying constant, it's 30 days in year one versus 30 days the prior year, then I know I've done something wrong with my formula. All right. In this case, receivables go up from 16 to 17.5, basically a 5% increase, consistent with my revenue growth, and because my receivable days stay about 29, 30, that increase makes sense intuitively to me. When you see big changes, that's when you need to get worried. Okay, now we're going to do a similar calculation for inventory. In the case of inventory, however, we use cost of goods sold as our base instead of revenues. All right, so if we take the base formula for calculating inventory days, that's calculated by taking inventory over COGS times 360. Just like up here, in this case, I know what my inventory days assumption is. It's 45. I know what cost of goods sold is because I've already calculated it. 360 is a constant. I'm going to do the same algebra up here. So if I'm solving for inventory, the formula I need to use in my model is inventory days times COGS divided by 360. Make sense? Same math I did a moment ago. Again, we're just using COGS, cost of goods sold, as the base instead of revenues, because inventory is closely related to cost of goods sold. All right, so to calculate inventory, I want to take this year's COGS, H10, times, control page up, H23 on the model tab, my inventory days, 45 days, divided by 360. And I should get 10.5. And the quick eyeball or the quick gut check I'm making, I see inventory increases by $500,000 or 5%, consistent with my revenue, my cost of goods sold growth. And I haven't changed my assumption regarding days, so it makes sense to me. If you get a radical change in inventory, either up or down, it should tell you you've probably used the formula incorrectly. Once we have that, we can fill to the right, F9 to recalc, and inventory should grow from 10.5 in year one for 2009 to 12.8 in 2013. And the last item in my other current assets, or in my current assets section, are other current assets. We're just going to link back to our assumptions tab. H24 on the assumptions tab, we're holding other current assets flat at $1 million. And then we'll fill that to the right. And now we can sum up our total current assets in each year. All right, well, here we come to one of our first subtotals that we need to calculate. We need to calculate total current assets. There are basically 3 different ways that we can sum these up. Okay, I can go through and I can say equals cash plus receivables plus inventory plus other current assets. All right, a lot of different keystrokes, not really that efficient. And at the end of the day, if I do it this way and then later I come back, I edit my model and I insert a row in here, maybe we've got another category of assets we need to take into account, it will not automatically pick that up. So that's the least preferred way of summing these up. All right. The second way to do it is to use a sum function. Greatly preferred in this case. The way a sum function is set up is to say equals sum It's a function that's built in within Excel. So when you say sum, Excel knows what to do. And then you need to tell Excel what numbers you want it to add together. In this case, what range do we want Excel to sum up? So equals sum, open parentheses. Now you need to specify a range. And in this case, our range is cash all the way down through other current assets. You can hold down your shift key, use your arrow key to select that range. You can hit then close parenthesis, right parenthesis, and hit enter. Again, a sum function equals sum, and then highlight your range. And the syntax Excel uses to specify a range is usually if you're selecting, more than one cell, it will take the first cell in that range, in this case H47, then it'll put a colon, and then it'll take the last cell in that range, in this case H50. And that's telling Excel sum all the cells in that range inclusively, first cell through the last cell. In this case, you should get 29 million. Right? In many cases, that's the best way to sum something up. Okay? But in this case, there's a third way to do a sum function, and it's also a little bit of a quicker way. Does anybody know what it is? Actually, it's alt equals. But basically, if I reverse what I've just done, if you hit alt equals, that is the shortcut for doing a sum function, and it will automatically select the cells directly above, or maybe if you're summing from the left to the right, we'll select those cells to the left. But in this case, it'll sum up until there's a blank cell, and it'll stop right below that blank cell. In this case, this works because it automatically highlights and selects the range that we need. If we had, however, a number up in here, in this cell here, and we tried to do alt equals, it would automatically include that regardless of whether we wanted it or not. So you need to be a little careful in terms of when you use alt equals. You can't always use it, but in some cases, when you can, it's the quickest way to get a sum function. And again, now because I'm using a sum function, if I ever insert a row in between here, that row will automatically become part of that range, and it will automatically get picked up in my sum, right, as opposed to going through and saying equals each individual cell. So once you have that, Control R, fill right, F9 to recalc, you should see current assets going from 29 million in 2009 to 35 million by the end of year 5. All right, let's go on to gross PP&E. If we remember back to our instructions page, and I don't, so I'm going to go back there, we're going to calculate gross PP&E. Actually, we don't really need to go back to the instructions page. Gross PP&E this year is going to be equal to last year's gross PP&E plus our CapEx, any capital spending we do during the year to acquire fixed assets, less any asset dispositions we have. All right, pretty straightforward formula with one twist. And the twist is that CapEx in our cash flow statement is listed as a negative. All right, so if we want that to be an additive, if we want to add it to gross PP&E, we actually need to subtract that negative. All right, subtracting a negative treats it as a positive, so we're going to say last year's gross PP&E minus this year's CapEx minus any asset dispositions we have. So our formula equals G53 minus H96 minus H97. All right, and if we have any asset dispositions, these would be positive. All right, because we're selling an asset, we're getting cash for it. That would be a positive number, so if we subtract it, we'd be taking it off of our balance sheet. All right, so make sure you get the sign right. Most people, when they make mistakes in modeling, make mistakes in their signs. using a negative where they should use a positive. This is a key place where people make mistakes. So make sure you get the formula correct. Equals last year's gross PP&E, G53, minus H96, minus H97. You'll want to fill that across to the right. And of course, right now, it's just going to be that same number every year because we haven't gotten to CapEx, we haven't gotten to asset dispositions yet. All right, so right now that number is flat, but ultimately when we have CapEx, it will start going up every year. And now that we have gross PP&E, I want to scroll up and show you something that I've been talking about nonstop since we started. Now we have depreciation. Okay, remember depreciation, we set it up, it's dependent upon gross PP&E. Now that we have gross PP&E, we've got $6.5 million of depreciation every year. That's flowing through our income statement, reducing our operating income, reducing our taxable income, reducing our net income. All right, so that's why I've set up the model the way I did. It's starting to pay off now. Anybody need a second to catch up? I just wanted to show everybody that. Next item, accumulated depreciation. This represents, and I think we touched on this in day one as well, but as a review, this represents all depreciation expense that's been booked on our fixed assets for the entire length of time they've been on our balance sheet. So the way we calculate this each year is to take the prior year's accumulated depreciation and add this year's depreciation expense from our income statement. So in H54, I want to say equals G54 plus H16 depreciation. It should be 51.5 in year one. And every year it's going to increase by the amount of depreciation that we have that year. Now we can calculate our net PP&E, which is basically the difference between the two, gross PP&E minus accumulated depreciation, equals H53 minus H54. Fill that across to the right. All right, again, these numbers are going to change because we don't have any CapEx in our model yet. But for now, the formulas are correct, and that's all that's important. All right. Then other assets, remember on our assumptions tab, we had those listed at 0. We're just simply going to link to cell H25 on the assumptions tab. And then goodwill, remember goodwill can no longer be amortized. What that means is that it's going to stay the same every year. We're just going to keep goodwill equal to the prior year's ending balance. So in H58, I want to say equals G58 plus, now I want to use the sum function here again, because I want to sum everything. I want to sum our net PP&E all the way down through here. So I want to say equals H51 plus sum, left parentheses, and then I want to select H55 through H58, this range here. Right parenthesis, close, or hit enter, and then you should have 305.7. And you can, as always, fill that across to the right. All right, let's move on to the liabilities and equity side of the balance sheet. First item we need to calculate is accounts payable. All right, and similar to our AR days and our inventory days, we're assuming a number of days in which the company pays its vendors, accounts payable days. This is also related to cost of goods sold because it's buying usually raw materials for inventory and whatnot. All right, so accounts payable days. Accounts payable days are calculated by taking AP divided by COGS times 360. If we're solving for AP, we do that same algebra. AP days times COGS divided by 360. Nothing new. So in my model, what I want to say is equals cost of goods sold or H10 times control page up, H29 on the assumptions tab, divide by 360. And just like with inventory, just like with AR, I get a slight increase in AP, about 5%-ish, which makes me feel comfortable. There's not a radical change here because I haven't radically changed any of my other assumptions. Fill that to the right, F9 to recalc. Next, accrued liabilities. We said in our assumptions this would be 3% of COGS. So I want to multiply cost of goods sold, or H10 times control page up, H30 on the model tab. Accrued liabilities as a percent of cost of goods sold. That 3% should give me $2.5 million. My other current liabilities, it was cost of goods sold times H31 on the assumptions tab, 2%. So again, H10 on the model tab times H31 on the assumptions tab. Should give us 1.7. And when we fill those to the right, hit F9 to recalc, we'll see those growing as cost of goods sold increases. Yep. And now we can sum up total current liabilities. Question is, can we use alt equals here to do a sum function? Yes, we can. The reason is when we use alt equals, it's going to go up. Again, it's going to capture that range all the way up to right before we have the next empty cell, which in this case is exactly what we want. All right, so alt equals gives us the sum that we want. It should be 15.9 in year 1, growing to 19.3 by year 5. Now we come to our debt, our revolver, our term loan, our unsecured debt. And remember when we talked about modeling at the beginning of class, we were going to calculate these balances using a debt schedule. All right, so the balances for these are actually going to come from down below in our model. We're going to set up the links to those now, calculate the amounts later, and those will automatically update. So for our revolver, what I want to say is equals. I'm going to scroll down to my debt schedule. Ending revolver balance H116, 116. For my term loan, it's equals H123. For my unsecured debt, it's equals H130, 130. So H116 for the revolver, H123 for the term debt, H130 for the unsecured debt. And for my other liabilities, I want to say equals H32 on the assumptions tab. Remember, we assumed that these would be $2 million per year. These are long-term liabilities. Maybe they're pension liabilities. Not really sure. But at any rate, we assume $2 million per year. H32 on the assumptions tab. And now we're to the point where we can calculate total liabilities. Again, I'll ask the question, can we use alt equals to calculate this? No. In this case, we can't. What we're trying to calculate is total liabilities, including total current liabilities. Alt equals is only going to give us these 4 that are right above us. We still need to capture this one up here too. All right. So instead of alt equals, let's do equals sum and then manually select that range.